Hello and welcome to the Harwood Report for July 30th, 2018, presented by Trade Academy. I am your host, Keith Harwood, the founder of Trade Academy. I always put the legal disclosures out here. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read through the rest of those relatively quickly and then we'll get to the content. Alright, that should be good enough. This week's highlights, I'll talk about the markets. What are we doing? What's going on? How is this money flow hitting S&Ps, tech, small caps? What are we seeing out of VIX? What's the trade in bonds? I think there might be something kind of brewing there. Gold is getting really interesting. Oil is getting really interesting. Maybe those sort of things are even more interesting than the major equity indices, but let's take a look at all of the charts and the sentiment that I'm seeing in the market. So first off, I want to point out that a lot of people look at the CNN Fear and Greed Index, and right now we're seeing it at 64. I don't believe that's accurately portraying the real quote-unquote fear in the market. We've gotten a lot of long liquidations. Facebook earnings, Netflix earnings, Twitter earnings, Intel earnings, they seem to be giving a little bit of fear spooked into the market on the tech sector. That doesn't necessarily get read through the stock price indices that they use because they focus on S&Ps. So the S&P return is a lot better than bonds. Well, bonds have also been weak. We're going into a Fed meeting this week. We've got more Apple earnings this week. That could have a big impact. We've got the non-farm payroll data coming out on Friday. That could have a big impact. All that could really start to change this stuff just off the bonds. And that could completely change this metric without actually moving, like the Fed moves and non-farm payrolls. That could move bonds just enough to make this metric change, ignoring what happens with stocks. So I tend to discount this metric, and I have been for a while, because for a while, it was bonds and stocks just went up together. Right now, they're kind of coming down together. It's not a really big indicator right now. You just see it's kind of a chop. How is that greed? Stock price spread. This is not extreme greed. Look where we're at, 2,000. Look where we were in January, closer to 3,000, 2,800, whatever. 2,500 here, 22, 23, 24, 2,500 in 2017. Yeah, we're at the highest breadth for the year, but we're not showing massive greed like we did in 2017. Why would that be listed as extreme greed? Because they focus on the short term, apparently. Extreme greed on the new 52-week highs just because it's positive? Like, look at the measure we were getting all of 2017, and even earlier this year. I don't buy it. And then we've got neutrality out of the junk bond demand. Okay, I mean, neutrality out of the VIX. Yeah, okay, maybe. Neutrality out of the S&P and its 125-day moving average. I kind of agree with that. And so a little bit of fear they're showing on this 5-day average put-call ratio. Why? Because it's not as, cheap here or as low here as it was in January. I don't know. I mean, the real fear here obviously is up there. I'd say this is actually probably neutral as well. So I don't think that there's anything really here other than that. I think everything's kind of neutral. And maybe a little bit of fear when you actually dig down into the internal metrics of the market, where we're seeing big name, FANG type stocks getting hit. But, starting to see some money flow go into things like, the industrials. Caterpillar had good earnings today. So let's take a look. S&P 500 is weakening as I speak. So people are clearly trying to reduce their risk before Apple's earnings. So I'm telling you right now, I think that if Apple has really strong earnings, we got a really big upside. And if Apple has weak earnings, maybe things get a little bit crazier to the downside. But yeah, Apple, I think it's going to be hard to punish Apple, given that Apple is still a profitable company. The two big names that got hit this week were last week were Facebook, and then prior to that was Netflix. Remember that these are names that are all, built off of the internet, built a lot off of active users. Apple sells, more of the hardware. Obviously, they do have their software suite as well, the cloud and everything else, iTunes, etc. But it seems to me like it's going to be a lot harder to really crush Apple than it was to crush Facebook. If we were talking about Tesla being the driver of the market, which also has earnings this week, I'd be a little bit more nervous. But when Apple earnings come out, that could really help the market if our earnings are good, because then it helps give a little bit of confidence that Apple, Amazon, and Google are all good. Microsoft was good. We've got some good earnings out there in the tech landscape. It's just that it wasn't in Facebook, Netflix, or Twitter. So let's see what happens with Apple. if Apple can basically, firm off of earnings, I think it's going to $200. I mean, that seems like an easy little target for it. And then that starts to, I think, get the market back into thinking about new all-time highs. Speaking of tech, so this is the main focus, obviously, in the liquidation event, and that's the Qs. And the 50-day moving average has been support, and we are testing it today. So do I think that the 50-day moving average will definitely hold? No. I mean, I think that it's probably likely that it will for today, but tomorrow's Apple earnings will determine whether or not this moving average holds. So what does that mean? It means that I don't think that I need to trade off of this inflection point today. I'd rather wait to either get confirmation or, if anything, I'd be more inclined to fade this because I think that the, computer programs and everything that are out there and the lean is to basically let this continue to be support. So I think the probability is that this creates support, and Apple earnings, though, will be the confirmation or the rejection of that thesis. In terms of the other one that I focus on here in the small caps, you can see that this weakness is a little bit more damaging in terms of the moving averages. It's through the 50-day moving average already. There's not a lot of downside left until we get to the June lows. So, it's a little bit wishy-washy for me in IWM only because moving averages haven't always shown to be incredibly important in small cap. And I think that's partially because small cap money flow is often also driven by some of the bigger cap names. So the S&P money flow then kind of feeds through the small cap when people are looking for more beta and things like that. So I don't want to overstate the importance of a moving average in small caps when I think the tech and S&P moving averages are going to be more crucial for the overall market direction. And I mentioned it, and I didn't put it on the slide that I want to look at this, but the Dow Jones Industrial Average is looking a lot better now. Remember, this is supposed to be the sector that gets damaged by the trade rhetoric. Well, what did Caterpillar do today on earnings? Faded because of the market, but it blew it out of the water. So everything that got in trouble with Caterpillar last earnings, where they said maybe this is as good as it could possibly be, I kind of read that as bullish, not bearish. But obviously the market wanted to was looking for a bearish thing last quarter, saying, well, you can't possibly beat again. And that's what you're saying. Well, then today they beat and raised guidance. So, maybe things aren't all that bad for all the industrials. I mean, even Goldman as a bank looks like it's starting to turn back around. So there's a lot of good stuff going on, I think, in the internals of the Dow Jones Industrial Average and the S&Ps. It's just that tech is weighing right now. So there's a lot of trades that I can look at here. I go through some of the volatility metrics and ways to play all these indices in the premium newsletter. I'll talk about that at the end as well. But just be aware that the actual trade concepts are going to be in the premium product, not in the free newsletter anymore, or the free video anymore. So let's move over to gold. First off, gold, you can see that it's just rejecting at that 10-day moving average. Doesn't seem to want to burst through. But when I look at my main indicator, which is dollar yen, you can see that is not bouncing back. So if the market continues to be weak, I expect to see dollar yen weak. The potential problem here for that trade overall is I got the Bank of Japan tomorrow, and I got the U.S. Fed on Wednesday, and then I got non-farm payrolls on Friday. All of these things could really move the dollar yen ratio. Gold vol's getting cheap. Am I bullish on gold overall right now? Absolutely. Why? Because right now, my signal that I use in the dollar is saying to be bullish on gold. And when it's at lows and looks like it could have an explosion if we get a squeeze through the 10-day moving average, maybe that creates a gold short squeeze. That gives me leverage, especially when volatility is about as low as it gets in gold. I also want to point out how low volatility is in silver, because that is similar, obviously. So silver tends to perform a little bit better when overall commodities are performing better. Well, guess what? USO is bouncing back. So I had a big pullback, whatever that was, about 3 weeks ago, and now it seems to finally be climbing the ladder again. So it's climbing the ladder. That's putting some momentum into XLE, which is flirting with that potential to break out and go above 80 here. If oil continues to firm, that could happen, and it could happen fast, especially if the market is no longer a headwind for these energy companies. Right now, there's a headwind. People are liquidating positions. Okay, so when they finish that liquidation, what do you think they have to do? Well, they have to start taking off some shorts. And if people have been generally short energies, which seems like it's been the case, that could create some explosive move. Maybe more explosive would be an OIH. It's already getting a move today. But remember, XLE is already testing the recent highs. That would put OIH up to 30 if something like that were to happen. So remember where we're at relative to further back history as well as short-term history. Yeah, there's a potential for some consolidation here around 27.5, this previous range. But if XLE is exploding, people are going to go for all of them. And then the other one that I just want to point out here that, again, I didn't put on the slides is XOP, because this has had a higher correlation to oil. It looks a lot more like the oil chart, and that, again, could go to a new high here. Want to just show you guys on this. XLE vol is around 16 right now, so yeah, Friday got really stupid cheap despite all the market liquidation stuff. It's really cheap for the last 6 months. If I go a longer term, you just have to know that this could get back down here if we switch to 2017 mode. But switching to 2017 mode, I think we've already gotten a good run in XLE. So vol's pretty cheap there. OIH vol is also pretty cheap. It could go down to 23, but from 24.5, we're talking about a pretty low level, pretty low base. So what am I getting at? If the market stops this long liquidation, if money flow returns at the beginning of the month positively, if oil continues to firm, and I've got cheap vol, meaning cheap leverage, these things I think should be played with calls, and that's how I am playing OIH right now. Being long calls, because that's where I get my leverage, my defined risk, potential for a home run squeeze. Okay, so if you want to know what calls I'm looking at right now, you can go to the newsletter. It's $49 a month until tomorrow. Tomorrow it jumps up to 97. It's free for the first 2 weeks. So if you sign up today, you get to be in at $49 per month once the free trial expires in 2 weeks. So you get 2 weeks for free and then $49 a month. If you sign up tomorrow, you're going to get 2 weeks for free, and then you're going to be paying $97 a month if you want to continue to get this content. So if you want to have the option to get this cheap, you should act today. Otherwise, it's going to get more expensive. All right, guys? In that, you get actual trade concepts that I'm looking at, the actual implementation, pairing the volatility with the technical analysis and the overall macro feel. And then I do also a Wednesday update video. So you get 2 videos per week, the free one on Monday along with the newsletter, and then the premium one on Wednesdays. It's a lot more content. And if you want to email me, I'm keith@tradeacademy.co. That's the best way to get a hold of me. I included my phone number, my Twitter handle, and my web address there in case you want to check it out, check that stuff out as well. All right, folks, have a great rest of your trading day. I would look forward to seeing all of you on the newsletter by this afternoon.